It's Friday night. You pull up to the ATM, screen's lit, but it won't give you cash, just a cold message, temporarily unavailable. You drive to the next one, same thing, and in that moment, you finally understand the money you worked 40 years for was never really yours. It was an IOU in somebody else's system. It was a warning flare. Gold didn't drift. It got hit. Silver didn't wobble. It got crushed. Gold around $4,185 an ounce on February 5th, 2026. Down about 76% in a day. Silver around $71, 57 an ounce the same day, down about 23%. That's not a normal move, that's a trap door opening. And here's the part they don't want you staring at. Just a week earlier, gold was up near 517s. Silver was up near 116, 84. So what did we watch? A blow-off, a panic, a relief rally, then another slam. That's the casino. And the house always has a lever. They'll tell you it was profit-taking. They'll tell you the dollar strengthened. They'll tell you yields moved. They'll tell you volatility. Yes, those are the matches. But the gasoline is fear. Because gold and silver are not just metals. They're a report card. They're the smoke alarm. And when the smoke alarm gets loud, the system doesn't put out the fire. It tries to rip the alarm off the wall. One question, just one. If everything is fine, why do they work so hard to calm you down? Why do they talk to you like a child? Why do they call you retail like you're cattle? When gold and silver rise hard, it exposes what the dollar is losing. Purchasing power, trust, control, and if you're 55 plus, retired, living on savings, depending on fixed income, you don't have time for cute explanations. You're standing on the Titanic, arguing about the music, while the bow is already underwater. Now, I'm going to do something most channels won't do. I'm going to connect the dots, slow, clear, so you can see the whole machine. Because once you see the machine, you stop being the sleeping herd. And that's the difference. Awake people prepare. Sleeping people cope. Until they can't. Imagine this. It's not a headline. It's not a rumor. It's your life. You wake up. You check your account. The number's there. But the money is not. Not because it vanished. Because it's fenced. A limit. A delay. A temporary measure. Temporary, like temporary inflation. Temporary, like temporary emergency powers. Temporary, like temporary bank holidays. And before you say, that would never happen here, remember something. A lot of things never happen until they do. Then everyone acts shocked. Then they say, no one could have seen it coming. That's a lie too. So let's talk about what moved the metals today and what you should watch next. Because you don't need opinions, you need signals. First signal, when the dollar and bond yields jump around, paper metals get jerked like marionettes. Why? Because the paper market is huge, bigger than the real metal. It's contracts, it's leverage, it's bets stacked on bets. So when big money needs cash, they sell what they can sell fast. That includes paper gold and paper silver, even if the long-term story screams, own it. Second signal, rate expectations. The moment traders think cuts are delayed, or inflation is sticky, or the Fed has to stay tight, paper metals can get whacked. Not because gold stopped being valuable, because the short-term trade got crowded. Then the crowd gets stomped. That's how it works, but that's the surface. The real story is underneath. Underneath is debt and interest, and a government that cannot stop borrowing. Right now, U.S. national debt is around $38. $5 trillion, let that sit in your chest. 38 trillion. That number is so big it feels fake. So let's make it real. If you owed $38, $5 trillion, you don't budget, you don't cut back, you don't skip coffee, you don't tighten your belt, you're insolvent, you're just still getting credit. For now. And here's the part that should make your stomach tighten. In fiscal year 2026, the government has already spent about $355 billion on interest. Interest, not schools, not bridges, not veterans, not Social Security. Interest, the cover charge to stay in the casino. Now picture the debt ceiling like a guardrail on a mountain road. The statutory debt limit is around $41, $1 trillion. So you've got a truck, it's speeding downhill, brakes smoking, guardrail coming. And what does Washington do every time? They move the guardrail, they suspend it, they raise it, they rename the problem, they kick the can. That's the pattern. And here's the rule of human nature. When people can't pay, they don't confess, they negotiate, they stall, they change terms, they change definitions, they change the value of what they owe you. Quietly, legally, with smiles, with speeches. Now let's talk about the safety net they want you to worship. FDIC. They want you to sleep like a baby because the FDIC is there. The standard insurance limit is $250,000 per depositor. per insured bank per ownership category. That sounds comforting. Until you ask the grown-up question. What backs it? A fund and a promise. And in a system-wide panic, a promise is not metal. A promise is paper. Now be careful here. I'm not saying your bank will fail tomorrow. I'm saying the structure is fragile. And fragile structures break when everybody leans at once. If one regional bank wobbles, they can patch it. If the whole system shakes, that patch becomes a printing press. They'll call it liquidity. They'll call it facilities. They'll call it stabilization. Translation? More dollars. And when more dollars chase the same groceries, the same rent, the same medicine, your savings buys less. Not overnight. Then suddenly, this isn't a theory. This is math. Debt grows, interest grows, and every fix adds more weight. So the question becomes simple. How do they keep the whole tower standing? They need two things. They need you calm, and they need confidence. Because confidence is the glue. When confidence cracks, everything becomes a run on banks, a run on bonds, a run on the dollar, a run on the system. And that's exactly why gold and silver matter. They're the escape valve. They're the truth meter. When people smell trouble, they move into hard assets. And when too many people move, the system panics. So what do? They manage perception. They hit the metals. They flood the news with explanations. They make you feel stupid for caring. They want the sleeping herd to stay asleep, because asleep people don't withdraw. They don't convert. They don't demand real delivery. They don't ask hard questions. Awake people do. Now here's where the trap gets serious. Imagine this. It's not an ATM that's down. It's your bank app. You log in. Balance is there, but there's a new line underneath. Available for withdrawal. $200. You call. You wait. You get a polite voice reading a script. Due to market conditions, temporary limits are in place. Temporary. Now imagine you try to send money to your daughter, or pay a contractor, or buy a used truck in cash. And the transfer gets flagged, delayed, questioned, not because you're a criminal, because the system is scared. And when a system is scared, it clamps down. Here's what most people don't understand until it's too late. Modern money is permission, not ownership. If your money lives inside a database, someone can freeze it, someone can throttle it, someone can decide what you can do with it. And the people making those decisions are not you. They never asked you, they never will. Now let's talk about the word that makes politicians sweat. CBDC, central bank digital currency. The official message is always careful. No decision, no plan, no move without authorization. Fine, that's the speech. But the exploration is real. The rails are being built, the plumbing is being upgraded. And here's the point. You don't build rails for nothing. Instant payments already exist. Systems are getting faster, more centralized, more trackable. And that matters because in a crisis, speed becomes control. All it takes is one emergency, one cyber event, one financial stability scare. And suddenly the next step feels reasonable. That's how the corrupt system moves, not all at once, one emergency at a time, one temporary measure at a time, one for your safety at a time. And if you think they would never do that to retirees, imagine this. Your cost of living jumps again. Your grocery bill is a punch. Your property taxes climb. Your insurance doubles. Your grandkids need help, but your savings earns 2%, while the world costs 12%. So you do what any normal person would do. You try to pull more out, and the bank says there's a limit. Your pension gets adjusted. Your benefits get recalculated. Your bond fund reprices, and the sleeping herd shrugs and says, well, at least the number is still in my account. Until it isn't. Now pause, because this is where people either get defensive or they get smart. If you're feeling angry right now, good. That means you still have instincts. That means you can still protect yourself. Because the people who get wiped out in crises aren't always the dumb. They're the trusting. They trusted the system. They trusted the promises. They trusted the talking heads. They trusted the casino. And the casino never loves you back. So what's the exit? Physical gold? Physical silver? Not as a trade, not as a get-rich play. As a lifeboat, as survival, as freedom, as a bearer asset. Meaning, if you hold it, you own it. No password, no app, no permission, no third party. And you need to understand the phrase that decides who sleeps and who panics. Counterparty risk. That's the risk that the other side can't pay, or won't pay, or changes the rules. Your bank deposit is a promise. Your brokerage account is a chain of promises. Your pension is a promise. Your bond is a promise. Promises are fine until everyone shows up at the same door. Then the door gets small and the crowd gets big. Gold and silver don't need a promise. They don't need a bailout. They don't need a vote. They don't need a spreadsheet. They just are. That's why central banks hold gold. Because when everything else is somebody's IOU, Gold is nobody's liability, and that's why they get nervous when regular people do the same. Because when you move into physical metal, you step outside the cage. You become your own central bank. Let me translate that into plain English. A central bank can create currency. You can't. But you can hold something they can't print, something they can't dilute with a keystroke. Gold can't be printed. Silver can't be printed. They can be mined. Slowly. Hard. With real cost. That's why they keep their value through storms. Now let's talk about the emotional trap that destroys retirees. Recency. People think tomorrow will look like yesterday, because that's how the brain stays calm. But the system is not stable. It's a pressure cooker. And today's metals action? That was the pressure gauge twitching. A big move up, then a violent slam. That's not normal. That's stress. That's confidence cracking at the edges. So what should you watch next? Watch the dollar. When the dollar spikes, paper metals often get pressure. But remember, that doesn't erase the long-term problem. It's the casino's short-term lever. Watch bond yields. When yields jump, markets get tight. Liquidity gets scarce. And leverage gets punished. That's when paper gets sold. Watch government interest costs. Because when interest becomes one of the biggest expenses, something has to give. They can cut spending. They won't. They can raise taxes. They will try. They can inflate. They always do. And inflation is the quiet thief. It doesn't break in. It doesn't announce itself. It just eats. A little today, more tomorrow. Then one day you realize the same savings you thought would last 20 years won't last 10. Imagine this. You're in the grocery store. You're standing at the register. You're buying the same basics: bread, milk, eggs, medicine, a little meat. And the total is so high, you actually laugh. Not because it's funny, because your brain can't process it. Then you go to your car, you sit, you stare, and you feel something you haven't felt in years. Fear. That's the future for people who stay trapped in paper promises, because the system is designed to protect itself first. Banks first, bonds first, politics first. You last. So what do? You build your own lifeboat. You don't need to bet the farm. You need to reduce risk. You need to shrink counterparty exposure. You need to own a piece of your wealth outside the machine. Because in a real shock, the only thing that matters is what you control. Not what an app shows you, not what a statement promises you, not what a politician swears on TV. Control. And the simplest form of control is holding real money. Now, I'm going to say something that will annoy the sleeping herd. If you're still 100% inside the system, you're volunteering to be the shock absorber. You're volunteering to be the bag holder. You're volunteering to be bailed in through inflation. And they will call it necessary. They will call it stability. They will call it for the greater good. But you will feel it as loss. Loss of purchasing power, loss of freedom, loss of options. And options are everything in retirement. When you're 25, you can recover. When you're 65, time is the one thing you can't print. That's why this matters. Now, let's address the elephant in the room. Metals are volatile. Yes, so is the system. Gold went down today. Yes, and the debt didn't, and the interest didn't, and the printing risk didn't. One bad day in price doesn't erase the reason you own it. You don't buy a fire extinguisher because you love carrying it. You buy it because fires happen. And when they happen, you don't want to be shopping. That's what physical metal is. A fire extinguisher for financial fires. A lifeboat, not a lottery ticket. Now imagine this. A real crisis hits. Markets lock, banks restrict, payments glitch, rumors spread, the sleeping herd lines up. They demand cash, they demand answers, they demand help, and they get told to wait. You're calm. Not because you're fearless, because you prepared. Because you took some of your wealth and put it somewhere the system can't easily grab, somewhere real, somewhere solid. That's the difference between panic and planning. One more thing to watch. And this one matters more than any chart. Rules. Because markets can fall, then recover. But rule changes? They stick. History shows it. In 1933, the U.S. government restricted private gold ownership under Executive Order 6102. People who thought, that can't happen here, learned the hard way. Different era, different tools, same instinct. Protect the system by controlling the exit. That's why you don't wait until everyone is running for the same door. And watch the language on the news. When you hear phrases like price gouging, hoarding, speculation, national security, protecting consumers, that's the script. That's how they prepare the public to accept new limits. Also watch one simple thing in your own life. Availability. If your bank starts pushing you toward digital only, if branches close, if cash access gets harder, if customer service becomes a maze, those aren't random inconveniences. They're the system training you to accept less control. Imagine this. You want to help a family member. You want to hand them money, real money. And you realize you don't have it because you were trained not to keep it, not to touch it, not to question it. That's the trap. They make you dependent, then they manage the dependency. So your job is simple. Own at least something that works without their permission. Something that doesn't need an approval screen. Something that doesn't expire when the rules change. So here's the deal. If you want to survive what's coming, you don't wait for permission, you prepare. You get serious about physical gold and physical silver, not because you're greedy, because you're responsible, because you're protecting your life's work. And if you want the truth without the lullabies, subscribe to AG Reporter. Not for entertainment, for survival, because the storm doesn't send you a calendar invite. It just shows up. And today's smash in gold and silver, that was thunder in the distance. The smart ones don't argue with thunder, they build the shelter.